Income shifting. Have you all ever read the book, The 4-Hour Work Week? Right? The 4-Hour Work Week, it talks and discusses this very principle of income shifting. Learning how to shift your money. Learning how to shift the money you make on your job back to you. Right? You may be saying, Queen, what do you mean shifting that money back to me? Right? You may be asked, what do you mean, Queen, shifting that money back to me? See, this is what you don't understand. The cash flow pattern. See, I teach on velocity banking. You know, this is my notes. This is one lesson that I did teach on velocity banking. People don't understand that a low interest rate on a mortgage on a $136,000 loan, for example, at 3.75% principal interest rate, you're going to pay back $510,000 in interest. See, your money is making someone rich. The question is who? On a home mortgage, it's the banks. See, the banks needed a product, a cash flowing product, right? Cash flowing for years to keep them wealthy, right? If you are a renter, then you're making your landlord rich, right? You're making the landlord rich. Your money is making somebody rich. Your labor is making somebody rich. The question is who, right? This is a breakdown of a person that has a very moderate and low $136,000 mortgage at 3.75% interest. $425 out of their $1,200 payment is going towards the interest. You're paying the banks this much, right? And so this is how I teach velocity banking and people that have high credit card limits to use their credit cards to attack the principal. See, this is, and I didn't mean to go here, but I just went to this chart, so I'm going to teach it real quick, right? I'm going to teach it real quick. See, it's called amortization interest and simple interest, right? Amortization interest is the interest on a mortgage loan. What does that mean, Queen? It means that that loan is front loaded with interest. That means it's piled with interest all within the loan note. Credit card interest is simple interest, right? I'm probably going to crop out this little section, you know, of the video and just teach about and have a short segment of velocity banking. Simple interest, meaning that interest cannot be charged on a credit card until the end of the recyclement of the 30 days. And whatever balance is reporting at the end of the 30 days is the amount that you are charged interest on. That's not true with a mortgage, right? With a mortgage, whatever the balance is when you first take out the mortgage on the loan is automatically calculated in interest, and which is automatically calculated into your payments. So you take credit cards, a simple interest, and attack it with amortization interest and pay, not sending in an extra payment like Dave Ramsey teaches, not sending in an extra $100 or $200 of principal payments. No, that's like putting a Band-Aid on a bullet wound, right? You take simple interest and you attack amortization interest at big lump sums at a time. It's like having a bullet, right, versus having a grenade. You know what I'm saying? And so that's how velocity, and I know now you probably say, Queen, no, I don't know what you're saying. I never heard of velocity banking. That's okay. Okay. That's a quick recap. That's why you don't want to cut up your credit cards, right? That's why you don't want to cut up your credit card. You want to use your credit cards to make you richer and to gain assets. Velocity banking concept is one of the ways credit cards can do that. All right.